All right, so what we're going to do then is we're going to change things up a little bit. We'll do a quick Q&A here where I'll talk to you guys and obviously give you some thought processes around how we deal with certain things in trading. So I thought, well, maybe that's what we'll have to do. So obviously it was meant to be supply demand in the markets. I can give you my thoughts, and obviously we can break down stuff on the charts. Like I obviously know where things are at, so we can talk about that. But if you have questions, let's say about psychology, you have questions about other things that do with trading or investing, your journey, what's going well and what's not going well, or anything else, please feel free to ask those and I'll answer them here. I guess it's a unique experience that we don't usually get to do. Usually we've got screens on and everything. But if you have a question about whether it be crypto, currencies, CFDs, or just even how do you manage your account, how do you scale in on out of orders, or psychology stuff, ask away and we'll answer those, because I just don't think this is going to work, unfortunately. Feel free. Otherwise, I'll give you a couple of tips, I guess, if I don't see any questions come through. I guess we'll start with this one. So a few people have been asking me what's my thoughts on, obviously, the crypto market and, more importantly, the S&P 500 and how this kind of bullish run's going. It's what we call the post-election pump. And it's a pretty common phenomenon. We've seen it for pretty much the last 4 elections, 2012, 2016, 2020, and 2024. And it tends to be more aggressive. So usually it's not just like what we've seen so far. It does tend to lead into further aggression. And this year, you've got to remember that as soon as this market's gone negative recently, what people have been doing is they've been moving towards the short side. So instantly people are trying to short it. Now, the reason I brought this up is because we do see a very strong correlation with post-elections into inauguration and this being a strong period of time for markets. But on top of that, we also tend to see people go against trends a lot. And what I'm noticing as I'm loading up these charts each day is it seems like a lot of people are trying to short against particularly the US 500, the US 2000, and even this crypto rally. And I always say, as traders and investors, you're better off going with the trend than not to go with the trend. So if you load up maybe side by side with me right now, and you have a look at something like Bitcoin, let's just say example, and you're loading up, let's say, a 2-hour chart, what you might notice if you put a 20 moving average on there is that the trend itself has been basically bouncing off this 20 moving average. Now, this 20 moving average on the 2 hour is what we call kind of like a dynamic support. And the market has continued to make a series of higher highs and higher lows off that level. Now, if you'd just been buying off the 20 moving average on the way up, that would have been on the 2 hour, that would have been a pretty good way to get into the potential of the trade here. But if you're trying to short it, you'll notice that even the most recent sell-off that happened over the last 24 hours, where it went to 86.5, that hit the 20 moving average again, and it's found a little bit of a buy off this. Now, I'm not saying that this isn't weakening because, of course, they're basically equal highs. We've seen Bitcoin reach close to 90,000 twice and then find resistance at those points. And it could be a double top, but to go against the trend is much harder than going with it. So what I just guess I'm going at is you may have accidentally shorted at 82,000, at 84,000, at 86,000 on the small timeframes. It would have been easier to be with the trend than against it in this case. That's just something that I think a lot of people are making a mistake of. People are going against these trends. It is not a normal piece of news information. This is a massive US election, possibly one of the biggest in terms of differentials, in terms of capital gains and taxation and all these types of things that were on the ticket. And of course, this is now the adjustment that's being made post that. So it's bigger than any normal CPI or any normal number that you would see. Danielle says here, I'm a little light invested at the moment, around 40% due to uncertainties around elections. So I'll just kind of quell that uncertainties concept again so you can just know this in the future. When it comes to elections, generally speaking, all stats lead to generally bullishness. Now, of course, you've got to make your own decisions, and I'm not here to tell you that you should have been all in or all out. You have to be comfortable with your situations. But if you're talking about just the data and the statistics, when it comes to how we see the overall kind of position when you're talking about coming to election, generally people are concerned. I actually did a poll on this, and I found that 60% of people were uncertain into the election and actually changing their investment structures. When in essence, no matter who wins the election in the US, markets were bullish to different degrees 3 months afterwards. So again, from an investment or from a multi-month perspective on swing, the actual market it tends to have that bullishness in it. That's just something that I thought was interesting to share with you. The data stats is pretty good. We have a question here. I think I would like to start scaling into my positions, and what would be the best approach? So obviously, I have to be careful here because dollar cost average is one, fixed percentage per day is another one. The general consensus is that that's just a strategy where you'll be more investing. So dollar cost average or percentage per day, it's pretty similar. I mean, it's the same kind of thing. Dollar cost averaging is just basically buying a certain amount at a certain time. There are actually certain days of the week that are actually better to invest in than others statistically as well, which is kind of interesting. So I'm not actually sure which day it is, but I would guess that probably be like Tuesday or something like that. Yeah, look, if you're behind in certain things, remember, I would always say make sure you're willing to risk what you're putting in and be aware of your situation. From a trading perspective, when you're buying into a trend like this, trading's fine. If you're trying to invest, it's going to be quite difficult because you don't usually get the types of pullbacks that most people would expect. So interesting question there. But dollar cost average and fixed percentage per day, pretty similar. I mean, they're the same type of strategy. Dollar cost is just a certain point. You're doing a dollar cost average in, and fixed percentage per day is basically you'd be just looking at stats from that perspective. And I doubt it matters that much if you're trying to load in recent times. Good question. Thank you very much. Yeah, this screen thing will not work. It's completely broken. I'll just quickly let everyone know. Other questions, guys? Feel free to ask them and we'll go through it. From your experience, this comes from Stuart. What are the best timeframes to trade from 4 hour, 2 hour to the daily? Yeah, it's a good question. So again, it depends on what type of trader you want to be. If I was saying what's the best time frame to actually overall be looking at markets, it's the weekly for sure, and then it goes to the daily. Now, you might say, well, wait a second, why the hell are you paying attention to the weekly if you want to day trade? Weekly tends to be where the biggest overall flows go. You've got to think about it as each weekly candle is the beginning and the end in terms of somebody has been doing a fight between the buyers and the sellers over that period of time. And what I always find is that the weeklies tend to have the largest inflows. So over the week, let's say Goldman Sachs or UBS will be actually adding to their position or maybe even pulling back on their position. And that will manifest itself over all of the days. And then that gives you a very clear idea of whether momentum is in the bull's favor or the bear's favor. From weekly closures, I can often get an idea of whether I want to be bullish on the smaller timeframes for the next week or not. So I'd say most people fail because they don't look at the weekly. If you ask me what's the best time frame in terms of setups for swing, there's not really about time frame. I come from the perspective of times don't really matter because you might look at a 2 hour or 4 hour, but what about the 2 hour and 20-minute chart? What about the 2 hour and 35-minute chart? You don't see those. It's more about market structure and supply demand. So that's the most important thing for us to focus on when we're looking at markets. And therefore, I don't really care too much about timeframes. I care more about the weekly flows and seeing that on price action and then bringing that down to the small timeframes. So yeah, don't worry about the time frame too much. Just worry about the structure, the supply demands, and of course, whether you've got strong flows in your direction. For most people, it's going to be the daily. The daily is going to be what most people use. I like the daily, but the weekly is the best. Even for day traders, it's the best. It gives you a good, strong bias based on flow, and it's probably what most people fail at. Again, I think that when I first got into trading and investing, I was focused on 1 minute, 3-minute charts, 5-minute, 15-minute, 1 hour, and I lost sight of the bigger picture, and therefore I didn't have a strong sense of where markets were really moving, and therefore I didn't have a strong price action basis. And I think price action, that's the key. We want to get that strong bias based on the evidence in hand. And we don't get that when we don't look at the higher timeframes. Good question. But yeah, 2 hour, 4 hour dailies are good. I would say weekly, daily, 2 hour, if I had to like break it down. Silvio asking a question with gold. I've noticed it has been retracing a bit recently. Any particular reason for this? Yeah, it's got to do with a cycle seasonality. It also has to do with the US dollar being very strong post US election and rate yields going up. So if you actually look at yields, and we can't share the screen right now, so unfortunately we can't look at it, but I can tell you that the US 10-year is, and I would put a US 10Y on your Pepperstone TradingView attached, obviously, software, or try to get a chart of US 10Y. And what you're looking for there is you're looking for the fact that we've got this downward trend line. And that downward trend line, you'll notice, is right at resistance ahead of today's CPI numbers. Now, that's important because the way we need to look at it is today's CPI numbers are going to be important. They may break it to the upside or bring it back down, but gold hates increased rates. And the reason is that gold is the oldest currency. If we think about gold for the perspective of the Egyptians, or we think about the Romans or the Greeks, they all love gold, yeah? And what happened was it became kind of the default currency of the world. Then what occurred is, of course, we made paper money. But if I can earn, let's say, 5.5% in the bank with my, let's say, fiat, my US dollars or my Australian dollars or whatever else, but gold is actually costing me to store it, it becomes more desirable to own currencies. So it's where most people fall into the trap of believing that gold is actually a inflation-based hedge. It isn't really an inflation-based hedge. It's great in stagflation, and it's particularly good in actually deflation. So we've had this really strong deflation move over the last 12 months. Gold's done very well. It's not the only reason. Of course, central banks have been purchasing it. There's about 6 or 7 different reasons why gold's done well. But it's the timing of where the gold is at the moment. It's the strong US dollar and, of course, the strong yields. And these yields are punishing gold's price. But gold had to do this. If you actually put a weekly 20 moving average on the charts, what you'll notice is we've come back to mean reversion, which is pretty cool. So good question there. Alex says, hey, Tom, silver looks like it's forming a morning star pattern. Again, guys, for anyone that's joining us here, unfortunately, we've lost the ability to share the screen today. Don't ask me. It's literally stuck, and I can't. I've tried deleting and removing, coming back in and out. So if you have questions, this is a Q&A session to get all of your whatever questions they are answered about trading, investing, and everything else. I think it's actually quite helpful. So some good questions coming through so far. If you have questions about particular index or anything like that, we can also go through the methodology for it. So this is a question from Alex. Says, hi, Tom, silver looks to be forming a morning star pattern above the area of demand. Does this look like a decent long setup in the daily chart? So I like to look at daily, so obviously that's important. Now, for anyone that doesn't know what a morning star or an evening star pattern is, it's basically where a market will come down with a big red candle. So 3 candle setup. So it's a 3 candle setup. We get one large candle coming down. Then we get usually, ideally, if it wasn't a currency or metals market, we'd get a gap below. We get some kind of long leg doji or wick style rejection, and then we get another candle that would go bullish. So yes, you could say silver has come down to a critical level. I would say the support of around $30.50 is very important for silver, and certainly oversold itself. So that means that we're definitely oversold when it comes to the silver chart at this point. Now, if it does end up bullish here and the market goes up, you may notice that when you look at the 2-hour structure, we've already seen a series of lower lows and lower highs just be swapped to the higher high. So silver actually is changing trend towards the upside from a scalper or day trader perspective. So we've done a few things here. Number one, I can look on the weekly and I can see exactly the level of interest and the fact that it's bouncing off that weekly 20 moving average. There's a lot of wicks around here. When I go to the daily, second best time frame, by the way, good question before, we can see there's nice support around here. We're finding some pressure on. And then, of course, as Alex says, if we end up getting the confirmation as well on the daily that it goes bullish, that would be good. But we do already have one really great piece of confirmation, which is that it's broken the series of lower lows and lower highs, and it's gone a low, a high, a lower low, and a higher high. And that usually means for a scalper or day trader that if that happens at a critical level, it could mean more bullishness actually comes through. So it's a great question. And of course, yeah, quite helpful. I'm kind of enjoying this one. I feel like, yeah, okay, we always do. We always do the normal chart analysis, but there's some good questions here. Keep your questions coming, guys, and we'll answer them throughout. Calvin, thank you very much. Hey, Tom, sorry to interrupt. You're not interrupting anything. Don't worry. We've got plenty of, we want questions. Bring them through. What do you think of silver on the 30-minute time frame, MACD Class A divergence? Okay, so another silver question, rightfully so, by the way. Is it an inverse head and shoulders, higher highs and higher lows, and looks, well, I like that, as we just spoke about, like we are breaking from a 2-hour falling wedge. Also on the daily, it looks like yesterday we rejected heavily. Could we see an upward move? Yeah, so I think we just talked about the idea that the improvement in structure, and remember, nothing's guaranteed. Yeah, we're playing statistics. When you're doing technical analysis, you're playing statistics. So what I'm going to do is, although you can't see my screen, I'm just kind of charting it based on what I'm seeing as well at the same time. And I think that you should also, why don't everybody do this? Get your chart out on silver if you can, or do it later, and get the downward trend line as well. And what you'll notice is there's a downward trend line, and I'm sure, can you guys see it? Can you see the downward trend line on a 2-hour chart all the way from the highs of October 29th? And what you'll notice is that it hasn't broken that yet to the upside. It's right on it right now. So it's struggling around that area. Now that's another thing that could signify strength from Alex's question before, because of course, to get a really good evening star or morning star, we'd like to see it, in this case, a very nice big green candle. So that would also be pretty sweet. Now, is it the inverse head and shoulders? No, but it doesn't really matter. That's irrelevant. The pattern is, fine, whatever, it doesn't matter. The trend has changed towards the upside. Now, MACD, and for anyone that ever wants to put this on their TradingView platform, you want to put in MT4 MACD on TradingView. And what you'll notice is the difference between the humps. So in this case, we actually have, at least on the 2-hour, we have from the low of November the 11th, the Monday, we don't have divergence, but we do have divergence between the 7th low, so that's the November 7th low, and of course the 12th, which is Tuesday. So is there Class A? Yes, but there will always be Class A in this case. So the Class A MACD divergence, which is basically where you have a more aggressive trend coming down initially, then this is now a lagged or slower trend, which is basically showing that this new lower low could be false, or it may be weaker and therefore not actually contain as many sellers as the initial sell-off did. Yes, you are correct. There is a Class A there. Good question. And obviously 2 people seeing silver and stacking different confluence techniques, which is really cool. Good question, Calvin. Does that help you out? I hope it does. Bring the questions in, guys. Keep asking, and we will go through them. Yeah, I like the silver from the perspective of the price action. I think it's improved greatly since probably only a few hours ago, about 8 hours ago, it started to improve. And that's price action for you. It's not, it's bringing together confluence, but it's not really based on any news or anything like that. It's just based on improvement in structure. Silvio says here, and oil also has been another one that I'm following well. Yeah, oil has been very tough post-election. I've been more on the short side until probably the last 24 hours. If you load up your oil charts, you'll notice that oil came down to around 68 a barrel. It was at 72, which was a pretty strong resistance level. And this is US oil that I'm looking at. And of course, it's rejected. Now, whenever you're doing oil, you want to look at both barrels. So you've got Brent and you've got US oil. And the reason you do that is just to see whether the charts look the same or different. Now, US oil actually improved over the last 24 hours from a small change of trend towards the upside. And what I did was I went back and had a look at the weekly. Again, we do love weekly charts. And I found that the weekly hasn't closed below 68 a barrel since 2023 in March. Okay. And it's been a long time. And every single time it's come down into this 65 to 68 a barrel, it's found buyers. Okay. Now that's what's been consistent so far. It doesn't mean it will be. We don't know that, but that's at least a piece of evidence. We know that there's some form of buyer for oil at around 65 to 68 a barrel on the higher timeframes. As we go down to the daily, we can see it came down very aggressively, and it hasn't quite hit the 67.50, which would generally be where I'd expect buyers to come through. But we did see, again, a switch on smaller timeframes, whether it be the 1 hour, the 15-minute, any of these timeframes. And what we saw was a low, a high, a lower low. And then, of course, we got a higher high and it changed trend towards the upside. So this is a fairly strong sign for a day trader or scalper that things could be starting to switch towards the upside. It's not as good as silver, but it has shown some strength here. So yes, at this current price, technically there are potentially buyers. And if you go back to the daily, what you'll notice is that 69, the high at 69 is a very important level. Yeah. Whenever you're looking at these markets, I always think of it as you want to build a complement storyline of around 3 to 5 separated reasons for why you want to be in something. And that doesn't mean you just use all these indicators like RSI, MACD, stochastic, that moving average, because a lot of those actually will agree with each other. It should be 3 to 5 separated reasons. So that could be volume, then it could be maybe one indicator, then it could be price action structure, etc., etc. If oil does rally, it's going to have some problems, though it is in a downtrend, of course, on the smaller, on the 2 hour, 4 hour, etc. It's going to have issues somewhere between $69.50 and $70 a barrel. So is silver not interest rate sensitive as gold is? Yeah, of course it is. It's also interest rate sensitive, but you've got to remember that gold is also improving at the moment, although it hasn't shown as strong a signs as silver. But if you actually took the silver gold percentage, silver went to 34.50 a barrel and 34.50 an ounce, and then busted itself down almost 13%. That's a fairly significant decline. Now, if we go and have a look at gold, gold is down 6.9% over the same time. So silver has fallen more, and silver is at a bit better technical level than gold is. Gold's at a point where it could have stop loss hunted people, but it's not quite at what I would deem to be a bit better in terms of strength, which would be like a 25.60 on the charts. Yeah, so it's a bit different there. Good questions, though. So I also got asked the other day a couple of things post-election, and I think one of them was, what are some of the risks of 2025? What should I be on the lookout for? So I always kind of think about things differently, and the way I always think about markets is, what were the main concerns coming into 2025 really, and does this election change things? Well, one of the biggest concerns for a lot of the markets that wasn't really being talked about is what we call debt rollover. So debt rollover, and again, keep asking questions, guys, and we'll answer them. Debt rollover is basically where you get all of these small institutions and banks and stuff that were not really making that much money, and they refinanced themselves before these high interest rates came through. And of course, that was going to be due in 2025 and 2026. So you've got this balloon, especially third quarter, fourth quarter of 2025 into 26. So that was a big concern from the market. Now, with the idea of a full sweep by the Republicans, what this is now opening up is in terms of effectively they're now seeing that as being, okay, maybe we can refinance these loans at cheaper rates and we can suddenly actually get these refinances done. And that's because of deregulation of the banks. Now, ultimately, will that be a problem? It could certainly be. I would be on the lookout of how does that play out, whether we see reinflation. Tariffs are inflationary in themselves. So we have to look for tariffs. Will we get them? That could certainly be a concern of the markets. And there is, of course, a lot of administration stuff. But just remember that we always build around statistics and flows and data, and we don't know any of those things yet, and we're unlikely to know the real answers until after the inauguration. So that's why the market's able to rally at this point fairly easily, because all it knows is that it's going to get a tax cut, or at least a rollover of the tax cuts from the previous administrations. Calvin says, what do you think of the NASDAQ 100 1 hour head and shoulders? Could this break the neckline? Okay, so we're looking at a pretty small time frame. So let's go and have a look at this head and shoulders. So again, it's against the trend. And if you load it up again together with us, so I'm going to use a 1 hour just to see. So theoretically, the neckline already broke if you're basing it on a 1 hour chart. So you would have broken probably the previous session. And you'll notice that that was around 21,000. So I don't think you could say that it's not broken. It would have broken because the neckline would have been about 21,000. And then we've closed below that, I believe, during the Tuesday session. Now, would I short against this? Probably not, because it is counter trend. And I do believe that it is better for people to generally be in the direction of trend than against it, especially if you're beginning. The notable level would be around 20,800, which would be, if you notice on the left-hand side, where we have a fairly condensed level of trade. And that's probably what we call the demand block, which is what we were going to talk about today. So there's a demand block around 20,800. That would be, if we do sell, that would be the kind of level that I would expect some buyers to potentially come through and find some pressure around that area. Very interesting zone. Obviously, not that easy to go against, though. You've got to remember this post-election rally is not like a normal rally. Normally, you see a CPI number or a non-farm payrolls number or PPI number or any of these other economic events, and you say, okay, cool, and then we forget about it. I always say if you can remember the event 1 month after it's happened, then you know that was a serious event that you should have been paying attention to the flows on. How many of you, and I ask you this to everyone that's watching right now, how many of you remember 2 months ago non-farm payrolls? And that's arguably one of the most important data points of the month. How many of you remember that? Let's get a shout out here. Put it in the chat. Do you remember what happened about 2 months ago in the non-farm payrolls? No idea, not me. I do, but that's only because I actually pay attention to the non-farm payrolls a decent amount, and obviously I look to see whether they've gone up and down. But most people won't even remember the non-farm payrolls. It's not your fault, it's just how it is. But how many of you will remember the US election outcome of 2024 for the next month, for the next 2 months, for the next 3 months? How many of you remember when the Fed pivoted and did 50 basis points? Quite a lot of you. These are pivotal points. If you ask yourself the question, it's really simple. Something I started to do, about a decade plus ago. And I said, will I remember this news in a month? And if the answer was no, then it probably doesn't matter. Isn't that good? That's a great hack. You think it's a great hack? I think it's a great hack. It makes a lot of sense. Yeah. So you don't really want to be, really considering paying too much attention to most news, but when you've got big news like this, it can lead into serious impacts. I'll read off a number here. So it's expected that the tax cuts, which are coming from Trump, you can see I've gone white, forward. This screen is going super white, so you can see here. But the tax cut is expected to be from 21% down to 15% for corporate tax. Now, I don't know, we can all argue all day whether that's a good idea or not. But if you notice here, the EPS benefit from all of these is actually only around 4% overall. So that's for earnings per share increase. Consumer discretionary will be up 6.8%. Com services 5.1%. Financials will benefit 4.6%. And what this does, it still has a compounding effect. This is just what they expect it to do. So it has a compounding effect. Automatically, if we have a Republican Senate, Republican House, and obviously Republican president, then you believe that you will get these tax cuts done. And that's going to add about 4 to 5% to the markets. And that's before you consider any of the other things that they might be doing. So that's why it's quite a big benefit. Is it when the market looked like it had crashed, everything was red that day? What do you mean by this question? Is it when the market looked like it had crashed, everything was red that day? I'm not too sure what you mean by this. But generally speaking, the market hasn't crashed a while ago. About non-farm payrolls 2 months ago. I was talking more about the number, but basically the numbers have been pretty solid. And of course, it got that one 2 months ago got halved. If you're talking about what happened on the session, then generally speaking, you're looking at going back and having a quick look into the Octobers, and the Octobers were mostly sideways. So I don't think it was really a crash day. It was just one that went up. So the market ended up powering through that particular non-farms. But since then, we found out that non-farm payrolls number has been halved. Yeah. With the August pullback and then again in September, is it normal occurrence in an election year? Generally, no, Silvio. It's not usually normal. So how we usually see this is during an election year, you don't tend to have usually market pullbacks well, you do have pullbacks usually in September or October. We didn't get that this year. Obviously, we've got early September a pullback and August a pullback. You have to be adaptable, though. See, years ago, I've used that seasonal for years, and I've been correct on it for years. You've got to apply. Unfortunately, everybody's started to use it, and I mean everybody. If this data wasn't so prevalent, I would think, and it wasn't in ChatGPT, I would think that it would be working a bit better, but it hasn't been working as well. So positive September and positive October, obviously, or flat October. But November, well, we know it's generally bullish. And the reason it's generally bullish into the end of the year is just because the market structure leading in was important. So what's becoming more important in these longer term swing plays is to understand market structure and to understand where we are in terms of cycle theory. And cycle theory is a huge deal. Like where we are in terms of cycles, obviously I have stuff on this, and is probably the biggest, most important thing to understanding where we are at this stage in markets. But the market structure was coming in, angling towards a sell even as early as July. Yeah. And that was pretty amazing when you think about it, because it bucked a lot of people's trends. The last 3 years, though, you've always seen sales in September into October. So again, it's a consistent percentage. There are other consistent ones in the markets. It doesn't mean it has to happen every year, and that's why you focus on the price action first. If you had a massive pullback in August, it's unlikely that you're going to have a massive pullback in September and October as heavily. And of course, that's what we saw price action wise. And by the time we saw the rally, and the rally went up to around the 20th and 21st of August, that rally told you that there was a lot of what we call animal spirits in the markets. The markets were actually quite bullish in that time. Question coming in here about how much higher could the US dollar go? I'm looking at trying to take a short on it. Well, firstly, I don't know if I'd short it yet or anything like that. Look, we do have CPI coming out in only a few hours. Then we've got PPI the next day, and then we've got retail sales. We're approaching some critical resistance points between about 106 and 107, and these will be some of the most important areas to note when it comes to the US dollar. So how does the US dollar trade? Well, generally it's seen as kind of like a net bull effect for the US dollar based on tariffs. So tariffs are what's pushing this up at this point, the expectation of tariffs. In this case, though, I don't think they're actually going to get them. Well, we don't know what's really going to happen, but generally speaking, again, even if you understand why it's supposedly moving up or any of these things, it doesn't give you much edge. The edge will come from the key levels and the way that it interacts with them. So if I was looking at the charts in the US dollar, I would be focused in on around 106.20 and 106.60. That particular range, which I would box up, will be where I'd expect possible reactions to occur. And if we do end up closing above, of course, 106.80, then the US dollar could go really, really high. That will be a fairly big weekly flow movement. Question. I've noticed the Australian mining community isn't faring too well and it seems to have stalled. Is it likely to change going on previous history when they're quite strong into January? Okay, so you're looking at a certain data stat. So, yeah, I mean, generally speaking, it's stalled because of China. So you've got to think about it. Who's the biggest buyer of mining commodities? And generally it's China. And China's economy has been stalling, and I would argue probably starting to recover, but the macro looks really bad on it. So what I generally look for when it comes to China is I'm looking at iron ore spot. So I'm usually kind of looking at iron ore, copper, and HSI. And those three particular three particular charts are what you're looking for to see whether the mining industry is actually coming back. At this stage, I could say iron ore is probably flat, copper is selling, and HSI is selling. So we're not really seeing a strong replicable trend towards the upside. Remember, just because you may have data that says go and do this here, you still need flow. And that means you still need price action. That's why we love TA here, and we talk about TA every week. And obviously next week I'd love to be sharing some charts with you guys because TA is in essence the real movement. That's where people are putting their money where their mouth is. And what we just saw in the US election, you may have been right, you may have been wrong, but we ultimately saw that most of the polls were wrong. The data doesn't lie. So obviously, as we found out who voted and what they were voting for, then that came perfectly clear. But again, it just comes back to what was actual price action doing. And in this case, we started to see an uptick in certain Republican winning stocks. And what I would notice is even I think the market made a mistake in the last couple of days where it started to pull up things like solar. So there was even confusion in the market. But of course, the Republican stocks have already been going weeks ahead of time. And those that were looking at it spotted it. And again, the price doesn't tend to lie because people love to stack into things before it becomes in the press. And I always have this saying, if it's in the press, it's in the price. So at this stage, do we see momentum in Australian mining and Australian commodities and just general commodities? Not yet. But as you guys rightfully pointed out, silver has started to look better on the smaller time frame charts for a day trader. And again, a day trader or a scalper may not care. Please, of course, use your own risk management, whatever you're doing in those particular orders. All right, we'll take one more here. We've got one from Stuart saying Barrick stock has done pretty poorly relative to gold, poor results. Yep, it always has been for a long time now. I know, but it seems to have done way worse. Have you any thoughts about this? Yeah, it's fundamentals problems. So they've got an issue on fundamentals. And while we're not really usually discussing fundamentals together on these shows, it's just they just don't seem to be very efficient. The management doesn't seem to be very good. And there are concerns there about, no doubt, mines and all sorts of things. So with Barrick or with any of these gold stocks or silver stocks, you've got to be a bit careful about the management of them and the fundamentals. That's why a lot of people love to trade and prefer to trade like gold spot or silver spot. Why? Because it's gold and silver. It's the real metal contract versus the stocks that, the companies that pull it out of the ground, but sometimes inefficiently and therefore do things poorly. They are notorious, these mining stocks, for having those types of things. But if you notice, Barrick has been underperforming gold price for years. This is not a new phenomenon. If you want to bring it up on your charts, you could type in gold spot. So you could have gold on the Pepperstone platform /GOLD, which is Barrick. And you can actually see for yourself the horrendous underperformance of Barrick versus gold over time. All right. Well, thank you very much for, of course, joining us here today, guys. And I very much enjoyed doing this little Q&A with you. Hopefully you've enjoyed it as well. As always, we usually talk about the markets. We go through the price action, talk about ideas with them as well. And unfortunately today, we had that little tech issue, but we managed to at least get the screen on and have a chat about markets. So it's been a very exciting time for many post-US election. Obviously, crypto is the big thing that's going gangbusters at the moment. And it had that huge move up to 90,000 on Bitcoin. And it was it's one of those things where I guess it's been doing very well, but data seasonality, I would encourage you all to have a look at what happens or what tends to happen post elections with crypto. We've actually shared some data on that as well, and over at FX Evolution. And I guess the other thing as well is it tends to spread, and you just got to remember with crypto, it's always about booms that are really quick and then busts that are also quick. So you've got to be aware that at any point in time, 20, 30, 40% of your value on those particular coins can go. So please practice correct risk management. All right. Thank you so much. We'll see you next week for our normal show. Same time, same place. And we'll catch you then. Bye for now.